So welcome everyone. Wonderful to have you all online. And what I wanted to talk through was that with the first webinar series that we did, which was around co-living, and that's where we basically had some incredible speakers speaking about the genre of co-living. It's an institutional asset class. It's one of the fastest growing sectors around the world at the moment. And this is certainly something that I am very, very interested in. I'm going to talk a lot about this today in this webinar. The second webinar we did was green. And this is really interesting. You know, we've got ESGs, which is environmental and sustainability, etc., diversity. But really, it's about green. And it's about green investing, green energy, green buildings. And there was an entire webinar done last week, which was absolutely phenomenal. And if you look at it, there's two major trends that have happened there already. There's the co-living trend, and there's the green energy trend. The third one is what we're going to be referring today, which the title of the webinar is called Diversified Living. And what is it really all about? It's called and is about diversification. So diversified living, I mean, I've just got off another webinar right now where they were talking about Zelensky, they were talking about the Ukraine, they were talking about the world and all the challenges that are happening in the world at the moment. And really one looks at it where if we take COVID and we take what's happening in the Ukraine, we live in very, very difficult times. And the question is it going to change? You know, literally last week, they had the worst floods in Brisbane ever. Now, what I find quite interesting is that they call it the 300-year flood. But in my memory, which was 10 years ago, they had another major flood, which they called the worst flood in 150 years. And 10 years later, they've had another flood, and now it's the worst flood in 300 years. Quite frankly, I would just say it's the worst flood in 10 years. Why do I bring that up? We live in a chaotic world. And what I wanted to present to you today and what I wanted to bring you today is how within that chaos we invest. How do we live within that chaos? And how do we marry together living and investing? And I believe that the answer comes in diversification. And it's about diversified living. And so when one looks at it, who am I? I'm not going to bore you with all my degrees. I don't think degrees really count for a hell of a lot, but just in case you do want them, I've literally got BSc and master's honors in property and technology. I've got CRS, which is the Certified Residential Specialist, which is the top qualification you can get out of America. I've got AIPP, which is the Association of International Property Professionals, which is out of England. And I've got CPD, which is the Property Development Program Master's, what's it called? MBA Master's Program in terms of, I'm not actually interested in talking about degrees. It's irrelevant. What's more important is that I've been investing internationally since 1999, since I was 22 years old. It's 23 years now. I've helped people invest in from 171 countries, over 1.2 billion. And we've invested in America, England, Australia, the UK, Europe, and even for those of you that are in South Africa as well. Why do I tell you this? Most webinars that I go on and most investments that I am part of, people find their one niche. They become London property investors, and they will tell you that London is always a good place. No matter what happens, they tell you to invest in London. And I personally think it's absolutely rubbish because countries, cities, sectors go up and they go down. They all go through cycles. And that as an investor, you should be able to read the cycles and know when to invest in certain sectors and when not. And then lastly, or two last things. One is I'm a published author. The book came out in 2014, Property Going Global. And I created a model, a four-dimensional model on the back of a scenario planning model to help us make better investments around the world, to do exactly what I just said, to not get caught up emotionally in one area or one asset class or even one partner, but to be able to diversify globally. And the part that I'm passionate about is helping people to have the freedom in their lives. And I want to just start with a little story. My uncle was here yesterday. Now, my uncle lives in Australia, Brisbane. Many of you have heard me talk about him many, many times before. And the story about my uncle is that in 1980, he started investing offshore. He started building up global assets. And in 2003, he wanted to immigrate from Zimbabwe with all the chaos that was going on in Zimbabwe to Australia. He bought his way into Australia. He bought a house for cash. He put his kid through a private school, and he never had to work for an Australian, which is a tongue-in-cheek joke. What I do find interesting, though, is 20 years later, his brother-in-law is sick here in South Africa. And he's able to fly out here, take a month off. Him and his wife have come out. They've come to help his brother-in-law. His brother-in-law doesn't have medical insurance. He's able to pay for him to do all of that privately. So basically look after him and be there. And for me, that epitomizes freedom. If you think about it, he can fly wherever he wants. He can fly whenever he wants. He doesn't have a day job that he has to worry about. And he's got the passive income to be able to make financial decisions which are good for him and his family and the people that he loves about. That, for me, epitomizes freedom. So let's look at this little book that I'm sure many, many of you on this have actually read, Rich Dad, Poor Dad. And they talk a lot about the E, the B, the S, and the I quadrant. Now, I'm not going to give you a whole lecture on this today, but ultimately, you've got the employee, you've got the self-employed, you've got the business owner, and you've got the investor. The employee is all about hard work, no security, and no time. The self-employed is large debt, insufficient funds, and ultimately, it's about a lot of stress. Okay, and unfortunately, in the world, 95% of people are in this space, and they only have 5% of the wealth. The business owner, it's about building a business. It's about building a system. It's about spare time. And finally, the investor, they have no debts, they've got plenty of money, and they've got freedom. And this is where 5% of the people in the world actually have this, and they own 95% of the wealth. And as I said to you, my uncle epitomizes someone in this I section. And so the question is, how do you get there? And that's what today we're talking about, diversified living. Let's just take a couple of steps back in terms of where this all started for me. This was my first property project when I was 13 years old. I converted a double bedroom into, we basically built on a double bedroom bathroom. When I was 22, I did my first development. I knocked down a 5-bedroom house and built 6 townhouses. At 24, I did my first property in London. We bought a 3-bedroom apartment or townhouse, if you want to call it that, and effectively converted into 5 bedrooms. And then we started a company. I started a company in 2004, helping people invest into houses or apartments. And that company, International Property Solutions, helped thousands of people invest into South Africa, hundreds into London, hundreds into Australia, and hundreds into America. What we noticed was that, and what I learned, was that truly middle-class investors invest into houses and apartments. And that most investors have a massive problem. They've got massive barriers to entry. They're stuck in country where they're exposed to literally, currency shifts or economic problems. There's massive barriers and hassles in terms of the overall, just getting into residential property, let alone commercial or international property. And then you take about all the different structures, the tax, the compliance, the banking, and really is super, super complicated. And then I learned in 2009, so we had the big crash in 2008, 2009. There was this development in Wimbledon in London from Barratt Homes, and it was 48 units, and they were in serious trouble. We could buy them at a massive discount, so 40% of replacement cost. And if you look at this email that I sent out back in 2008, 2009, I basically said it was an 8% net yield. And I basically said down the bottom here, I don't care what happens to the market values in the short term. This represents a real opportunity because they were built, they were tenanted, they had an 8% yield, and you were getting it at a 40% discount. The problem is that I needed a cool, calm, collected 10 million pounds, and I couldn't get people to work together to buy the building, and so we lost it. Then in 2009, I was with 2 very wealthy gentlemen in Bondi Beach, Sydney, and I asked them, what are you investing in? They said, medical buildings. And I said, what? Never heard of medical buildings. And they said, well, think about it. No matter what happens in the global economy, people need doctors. Secondly, doctors never leave their premises. And thirdly, doctors are very good at being doctors, but they're not accountants. So they sign very good long-term favorable leases. And I remember thinking, wow, like that's a no-brainer. I should participate. Unfortunately, again, $5 million to participate, we couldn't do it. But both those stories created enough pain. And that's why we created Wealth Migrate, which was an online platform to help people invest. And ultimately, we did our first commercial opportunity in 2014, where we raised $6 million from investors all over the world. And we bought this building, which we've subsequently exited and had a great result. So in my experience, having dealt with investors in 171 countries, why do they invest? The first is that they want preservation of wealth. The second is that they want a plan B. The third is that they want peace of mind. And the fourth is that they want freedom. And what I believe is so important when one looks at diversified living is that most people are trying to figure out the how and the what. But actually what you've got to start with is the why. And so what I want to share with you is we've got a document called the Wealth Plan. And I recommend that with the Wealth Plan, you reach out to us. If you fill in the survey at the end or speak to one of our wealth consultants, they will make sure that they share with you the Wealth Plan. We've even got a video, effectively a 60-minute course on how to do the Wealth Plan, because I fundamentally believe as an investor, when you get clear on your why, you'll figure out your how and your what. For today, though, what I think most people find is that, they might be in the beginner section, they might be in the intermediate section, they might even be in the advanced section. But the question is, when you get clear on your goal, then you get clearer on your why, and now you can get into your how and your what. So let's look at how you can actually diversify. The first thing I want to start with is the secrets to wealth. So there's a great book by Tony Robbins called Unshakable. He went out and he interviewed 50 of the wealthiest people around the world. And what Tony Robbins is incredibly good at is looking at patterns. And so the first thing that he did was that he went and he looked. And the first rule was don't lose money. Warren Buffett says, rule number one, don't lose money. Rule number two, refer to rule number one. Fairly self-explanatory. Rule number two, asymmetric risk reward. Now, I don't have time to go into all the details here, but in simple terms, we're taught by the financial industry, the higher the risk, the higher the reward. And it's absolutely rubbish. Wealthy people look for low risk, high reward. The third is tax efficiency. And the fourth is diversification. It's diversification across assets. It's diversification within assets. It's diversification across markets and currencies. And it's diversification across time. And I would actually add an extra one there. It's diversification across partners as well. If you had all your money tied up in Lehman Brothers, you would have a serious problem. The person that he refers to is a guy called Ray Dalio. And Ray Dalio runs the biggest hedge fund in the world, $160 billion. It is Bridgewater Capital. And it's really interesting because you can't get in there unless you've got $100 million liquid to give them, which is phenomenal. And now they're closed, by the way, as well. And he says to be successful, all you need is 15 uncorrelated bets in an attractive array of assets that don't move in tandem. And that will reduce the risk by 80%, and the risk return ratio increases by a factor of 5. Now, if I'm in a live room and I can see your faces, the way this generally works is that people just sit there completely confused. But actually, I want to point out how simple this is. All he's saying is that you need to make 15 investments in attractive assets that don't move in tandem. That's really all he's saying. So he's saying that you make 15 independent investments in quality assets that don't move in tandem. That's all he's saying. And if you do that, you'll increase your risk. You'll reduce your risk by 80%, and you'll increase your risk return ratio by a factor of 5. Now, 10 years ago, this was virtually impossible for most of us because we didn't have the money to go and make 15 different investments. If you wanted to invest in a house, it took a lot of money. If you wanted to invest in the stock market, it took a lot of money, et cetera, et cetera, et cetera. Nowadays, with technology, every single one of us can copy the strategy of the wealthiest people around the world. I want to share with you a second lesson. It's the value chain of real estate. So the old way of investing is that you and I are an investor and you want to invest in a house. And the problem is that there's actually 16 different middlemen between you and your investment. And because of that, there's no trust, there's no transparency, there's high fees, low returns, and no alignment. But let's look at the value chain of real estate. And having literally worked with wealthy people from over 170 countries, I would have been a bit of an idiot to not spot the patterns over the last 20 plus years. And what I learned is that there's 5 major steps within the value chain of real estate. The first is land zoning. That's when you've got a green farm and you get planning permission to actually build something. The second is a developer. They actually build a vertical structure. The third is an investor. They actually own the vertical structure. And generally, if I want to use fancy terms, they do what's called season the rent. So they stabilize the rental incomes. They then sell to a fund or a REIT. So a REIT is a real estate investment trust or a property fund. Basically, if you think about it, any pension company is looking to buy stable income. And by the way, this is the point that the most money is made in the whole value chain of real estate, when the investor sells to the fund. And then you and I come along and we wonder why we're battling to beat inflation. So if you look at the returns, the average land developer, I'm not saying they get this, but what they're looking for is an internal rate of return of 30%. The developer, about 25%. The investor, about 20%. The pension fund or the REIT or the property fund is looking for a yield or an income. And they generally are looking to buy a yield of somewhere between 5 to 8%. And then you and I come along and we're wondering why we battle to beat inflation. I've said it twice. It's important that you hear me. Now, you can go and read this article. You can see the link. Go to my LinkedIn page and you can read this article. This is not just my opinion. This is one of the financial newspapers which was talking literally about this and how a big property investor had amalgamated a whole bunch of shopping centers and was selling it on to a fund, and that the retail investors were effectively overpaying for this, the value of these assets. And what was really interesting is that the investor and the fund were the same company. So the question I always have for people, that if it's so obvious that the real money is made up the value chain, why don't you own commercial medical buildings, commercial office blocks, co-living, et cetera, or why don't you build them yourself? Because it's going up the value chain. And the excuses I get often are tremendous. And that's why I bring up the story of Uber, because before Uber arrived, we all had a private driver. None of us had a private driver. And, we would phone the taxi owner association, that would phone the taxi car guy, that would phone the taxi driver, and they would come pick us up. Nowadays, Uber's literally cut out all the middlemen. And what have they really done? They've cut the middlemen, they've cut the costs, and they've dramatically increased the trust, the transparency, and the accessibility. So here's a picture of one of my previous colleagues. He left his cell phone in his Uber and he got picked up. So if Uber can completely remove the middlemen, completely cut the costs, and dramatically increase the trust, the transparency, and the accessibility, why can't technology do it in the property space? And, again, when I ask the question why people don't do this, all the excuses I get are all the barriers. How do I protect myself? It's too expensive. It's too complicated. Sounds too good to be true. Compliance, I don't have time. It's too difficult. Management agents, et cetera, et cetera, et cetera. But the beauty with technology now is that this is accessible to you. And as Nelson Mandela said, money won't create success. The freedom to make it will. And so what we've done using technology is allow people to go up the value chain. You can invest in direct assets that earn an income. We call those income producing assets. And you can invest alongside developers in growth assets. So why platforms? Well, the key advantage of digital platforms is the ability to access more deals, invest smaller sums. Unlike REITs, these platforms allow people to invest in particular buildings, so you actually know what you're investing in. That's the Wall Street Journal. These platforms do more than provide access to institutional quality deals. They excel at disseminating critical information that investors need. So think about it, just like Uber. They cut out the middlemen, they cut out the cost, and they dramatically increase the trust, the transparency, and the accessibility. So that's the how. Now, what about the what? So with the freedom of investing, what do? Do you invest in America, in England, in Europe, in Australia? Or which partners do you choose? You don't know which country to invest in. You don't know which city to invest in. You don't know which partners to invest with. The world's a big place. It can be pretty complicated. Or even still, which property? Do you go out and buy an apartment in London? Do you buy a house? Do you buy an office building or a commercial building or a medical building or an industrial warehouse? What do you do? And that's really why I wrote the book back in 2014. Now, this scenario planner, Clem Santa, is one of the most respected scenario planners around the world. He's worked for many governments, including the Chinese government, helping them strategize long-term. And he has a strategic model. And as I said to you already, we built a 4-dimensional model on top of his strategy model so that we can make educated, informed decisions based on the data and based on fundamentals, not on people's opinions as to where to invest. And one of the most important things that you need to look for in investing is long-term trends. Just yesterday, as I said to you, my uncle was here and he said, trends are your friend when it comes to the market. So let's get real and look at diversification in terms of the strategy by the numbers, because I think this is quite important. I've given you quite a lot of theory, but let's actually look at the numbers. So I want to give you the first example. Now, this is a personal story. It's someone who's quite close to me, and he wanted to invest overseas, and he went to his financial advisor. And his financial advisor said he's crazy. He should keep paying down his mortgage, and that would be the best option for him. Now, he lives in a country called South Africa, and the economy there is weaker than, say, the American economy. And basically, the currency, the rand, devalues on average, and has done for 30 plus years, at 6% a year against the US dollar. So if we look at this option, and we use the analogy of eggs in a basket, he has all his eggs tied up in one asset, his house, one country, South Africa, one currency, the rand, and one partner. And actually, in this case, he is the partner. He lives in his house. He isn't making any money while he sleeps. So the number one principle of investing is you want to be making money while you sleep. And as Warren Buffett said, if you're not making money while you sleep, you'll be working for the rest of your life. And it's a classic situation of all his eggs in one basket. Let's look at another option. I met an investor a couple of weeks ago, and he was like, he wants to fly to London, and he wants to go, or fly to England, but fly to London, and basically buy an apartment. Now, remember, I've helped 2,500 people do this. So I've got a fair amount of experience in not only what works, but also what doesn't work. So let's say you fly to London and you want to buy an affordable apartment. It's worth £500,000. You get a 60% mortgage, which is quite aggressive, but you can get 50 to 60% loan to value. That means you're going to need to put in about £225,000, about $300,000 in cash. It's a 1-bedroom apartment. The investor will need to arrange a rental management partner to look after and find a long-term tenant, and ultimately to earn an income from the property. And when you look at it, they've pretty much got most of their eggs in one basket. So sure, they've diversified. The country they live in, they've now diversified by investing into England. But they still have the majority of their capital tied up in a single country, in a single currency, in one asset, with one partner. If the tenant stops paying, they lose all their income. And trust me, we've all experienced this. If there's factors such as Brexit or any economic setbacks, maybe like the Ukraine war, then the asset is fully exposed. If the rental management agent is good, and I'm sure that none of you have experienced a bad rental management agent, then the investor relies solely on that partner, because literally you're only as good as the partner on the ground to actually collect the rent and, not only obtain a tenant, but get an income and achieve success. And so what looks like quite an easy solution is actually fraught with a huge amount of risk. And again, the proverbial all your eggs in one basket. Option C. In 2014, I've already mentioned this, we focused on the medical sector as an asset class in America. Initially, we worked with multiple partners, buying up assets around the country with different partners. But in 2018, that company spun off and decided to consolidate into a single company. So rather than having separate assets in separate counties or cities with separate partners that were all well-performing assets and producing a high income, what happened with COVID is that my brother, as an example, is an anesthetist. And I thought, and I've always said, I thought medical was a phenomenal investment. But what happened was that with COVID, people only went in ICU. Any elective surgeries, so say, for example, I just had a knee operation on Friday. That's an elective surgery. They don't do that anymore because of COVID. And so all the ancillary medical services started to fall over. The people that do the x-rays, the physios, the chiropractors, the radiologists, you name it. And what was interesting is that this one company now, this one consolidated company, has many vacancies and they're not paying out their expected incomes. So I learned the lesson again. What you think is bulletproof is never bulletproof. Every single market, every single sector, and every single partner goes through their ups and their downs. If I, as an investor or any other investor, had placed my eggs in this basket, the investors had multiple assets, okay, a bit like a property fund or a REIT. However, their investment was still in a single country, a single currency, and with one partner. And to play on the metaphor, if the partner experiences problems or the sector experiences problems, they are fully exposed. And so I tend to joke, it's a bit like a partner carrying the basket, and sure, you might have lots of eggs, but they're all in the same basket. So what's the fourth option? Well, this is really the lesson that I've had to learn the hard way through diversification. As I said to you, I've been investing since 1999. I've helped thousands of investors and I've made lots of mistakes myself. And when I look at Ray Dalio, that's the advice that makes the most sense to me. Because if you take the imaginary numbers and you took $100,000 and you invest $10,000 into 10 alternative assets, quality assets, obviously, then you're going to be diversified across countries. You're going to be diversified across currencies. You're going to be diversified across assets, and you're going to be diversified across partners. And you're actually going to be doing exactly what Ray Dalio and the wealthiest investors in the world do. So if you look at that from a risk perspective, let's say that if you've got 10 assets, and anyone that's been a property investor for a long time will understand that it's, one or two. If you've got 10, one or two will not be performing optimally. It's just the way the world works. So if you've got 10 assets at $10,000 each, and two of them are not performing, you've reduced your risk by 80%. Because if you've got one apartment in London and the tenant is not paying its rent, you're 100% exposed from a risk perspective. But if you've got 10 investments at $10,000 each, and two of them are not working, you've reduced your risk by 80%. Are you with me? They also don't move in tandem. So you've dramatically reduced your exposure to one country, one asset class, one sector, one currency, and even one partner. And what's interesting is that because you diversified across 10 opportunities, your risk return ratio increases by a factor of 5, which basically means you're 5 times better off. Now, I'm going to show you why on a spreadsheet now. But before I do, actually, no, let me show you quickly. So this is what I call the freedom calculator. Okay. There's a whole bunch of scenario plannings that we do. This is a model that I built years ago. I mean, 15 years ago when I was, started investing in London, to actually be able to invest in UK properties, how it would work, the breakdown of the cash flow, what it would mean in terms of the annual cash flow, what it would also mean in terms of your capital growth, and ultimately your annualized return. And it's got all your rental escalations. It's got the full breakdown, taking into account tax and everything right through to year 25. Now, what I've done for today, and I don't have time today to go into all the details, but I basically built out the model for you in terms of this freedom calculator based on the 5 options that I've just shown you. So if I zoom in just a little bit here, and by the way, I will share this model with our wealth hackers, which is our internal community, is that first gentleman that said that he should, his financial planner said he should keep his money in the bank. So if he took $100,000, and if you look at these scenarios here, $100,000 at the current Rand conversion is 1.5 million Rand. You can see that he's got that. If he left his money at an interest rate, or whether it's an interest rate in the bank or whether it's a capital growth in his house, I think that about 7.5% is fairly reasonable when you look at returns, either on interest in the bank and or capital growth if the money's in a property. If you take the devaluation factor, it's about 6%. So that's option 1, and I run that option out for 30 years. Option 2, buy an apartment in London. So I know that you cannot buy an apartment in London. I want to be very clear here. But just to keep it simple, so that I could compare an apple with an apple, I said if you went and spent £200,000 and you got a 60% mortgage, you're going to need about £100,000 cash. Now, I know that that's more than, it's probably $120,000, $130,000. But bear with me, because I want to be able to compare apples with apples. And so I'm trying to show you that with a similar type of property, and by the way, you're never going to buy in London for £200,000. So you're probably going to be in, some secondary or tertiary city. But let's just compare an apple with an apple because it's quite important. If you take the growth year on year at 6.8%, that's pretty aggressive. The average is closer to 6%, the 50-year average in the UK. The net yield. So people say to me, well, 0.79% per year is a ridiculously low yield. Yep, it is. I've owned lots of property in England, and I can show you the cash flows and how it breaks down. If you take the current interest rate, and you can literally see here, like the breakdown of the costs, the mortgage, the rates and taxes, the vacancies, everything, it's coming out at 0.79%. So please don't argue with me based on opinion. I like to talk about numbers. And as I said to you, I've taken into account the rental escalations and everything. So these are models that I've used for more than 20 years to invest in the UK. So when an estate agent comes along to you and tells you you're going to earn 4 to 6%, that's great. Just do the modeling first, I would highly recommend, in terms of your actual returns. Then investing with one company. So again, let's just say hypothetically the medical sector in America. Your growth there per year, again, from experience since 2014, you're getting somewhere between 3 and 4% a year capital growth. Let's say 4. Let's be aggressive and be on the upside. Then you're getting a cash on cash return per building of about 7.5 to 8%. The problem is that at least 25% of the portfolio is not paying at the moment. So the net cash flow is closer to 6%, because you can see I said 8% times 75. So it's a reduction of 25%. Because again, if you invest in one company and they have challenges, then it affects you across the portfolio. Anyway, so there's your comparison. Then you've got co-living. So this is an opportunity we got in Australia at the moment. This is a new development. So it's not actually paying you an income for the first 4 years. It only starts to earn an income after 4 years. but it's got a capital growth of 15%, an internal rate of return of 15%. Now, just to compare an apple with an apple, because I don't know what the income is going to be in 4 years' time, and a number of our investors have asked us, can I invest in the growth phase of the business and then, reinvest into the income part of the business? Possibly. Remember what I said to you, and I'm going to explain to you just now. The biggest way to make money in property is to sell on to a property fund or a REIT. But to be conservative, I've put no income over 30 years. So literally just take into account the capital growth. And then lastly, and I just wanted to keep it simple here, but I wanted to diversify where you've got, say, 5 investments in the growth phase. And, it could be 1 investment, could be 5. But what I said was $50,000 getting you a capital growth. So generally in the growth phase, you get higher capital growth. And in this case, there's an opportunity at 15%. And then on the income side, I've put in the other 50,000 and you're getting, say, 5% capital growth and a 7% cash on cash income. So a total annual return of 12%, of which 5% is made up of capital growth and 7% is made up of income. And what I find fascinating, and again, I often like to talk based on models and numbers, is that people always have opinions. And by the way, what we're discussing today, I've discussed with a number of people that have had a number of very strong opinions. And so I decided to build these models, not only for them, but for myself, to look at what the numbers mean. So as I said to you, all of these extrapolate out for 30 years. And I then put it into a graph to tell me, because as an investor, where's my graph gone? There it is. As an investor, I'm only interested in what the numbers actually say based on the model. So before I show you, actually, sorry, I should have done this. In the chat box, tell me which is the best option to invest. Option 1, option 2, option 3, option 4, or option 5. Come on, let me know your thoughts. So Werner has said 5. Wendy has said 5. What does everyone else think? Trevor said 5. By the way, I'm trying to engage your brain here on purpose. So I'll put the rest of you out of your misery. And what's interesting is it depends, because it depends what you're looking for. If you're wanting purely capital growth, then one is better than another. And if you're wanting a balance, then another is better, etc. But if you look here, this option, the purple line, is actually option 4. So if you purely want capital growth, then it's far better option 4, which is purely to invest in growth producing assets that focus on capital growth. The next best option is option 5, which is a combination of growth assets and income producing assets. Okay, so this is what I call diversified investing or diversified living. The next, and by the way, obviously reduces the risk as well. The next one is buy an apartment in London, because at least you're getting the benefit of leverage. The next one is invest in one company in one sector in one country. And the next one is keep your money in your family home or in the bank. And as you can see, and I call this the Freedom Index or the Freedom Calculator, there's quite a stark difference between them. And if you look down the bottom here, I was just doing some percentages of the differences between these 5 scenarios. And it's really quite material, the differences in the amounts. The one ends up at $147,000. So remember, you start with $100,000, and in 30 years, you've got $147,000. This one is $718,000. This one is $343,000, option 3. This one's $6.6 million. And this one is $3.5 million. So if I go back to the diversified living and diversified investing, oh, what just happened there? Sorry. Where's my diversification? Where presentation gone? That is so weird. Where is my presentation gone? There it is. So I wanted to show you the numbers. Okay, this is not my opinion. It's the numbers. It's models and maths. Okay, and it's long-term trends. So again, someone told me recently they're going to, invest in England. They're going to get 20% a year. It ain't going to happen. It's not going to happen. I'm telling you, it's not going to happen. I've invested there for 23 years, and I can tell you categorically that you will not get 20% a year. Buying, just a normal house or an apartment. It just won't happen. So if you look at my last 12 months, I've invested in 10 different assets across 4 different continents, in 5 different currencies, in 9 different asset classes, and 10 different partners. And if I ask you the question, and we go back to this slide here, where's it gone? So I'm bouncing, but I actually just want to bring this up quickly. If we go back to this slide here with the 15 uncorrelated bets, in fact, let me copy this. Sorry, I should have done this, but I actually didn't think of this. It's quite a nice idea to compare apples with apples. But if we go what Ray Dalio said, and you consider what I've done personally, 10 different assets, 4 different continents, 5 different currencies, 9 different asset classes, and 10 different partners, would you say that I am on track? I'm not there because I don't have 15 different ones, but would you say in the last year that I'm on track to copying what Ray Dalio is recommending? And more importantly, if I can do it, and whether you got $100,000 and you want to do 10 investments at $10,000, or you do $1,000 and you do 10 investments at $100, would you agree that you are following the principles of Ray Dalio? Okay, so I see some questions coming in. I will answer them. So if you're wanting to look at traction, we've now helped investors from 69 countries actually invest over $100 million. They've been paid out $32 million in both distributions and equity. And what's important when I like to share it with people is that there's literally 4 simple steps as to how you can do this. You can sign up. You can literally go to the platform. You sign up on the platform. You fill in all the details like you would normally do. It's really quite simple. The second step is that you need to do your KYC. So you put in which country you come from. That does implement or impact from a regulatory perspective. You need to, it's self-certification, so you need to certify what type of investor you are. We then do the KYC, which is know your client, and AML, which is money laundering. It's all done online. For me, this is the only difficult part of the process. It takes a day or 2 to get the documents up, etc. Unfortunately, we work within a regulated environment and have all our regulations. The third step is that you go to fund your wallet. We've got a digital wallet. We work with Lemonway, which is the largest digital wallet provider in Europe. They're regulated by European law and backed by the top 5 banks in Europe. And what I love about it is I'm completely in control of my cash. I can fund my wallet. I can take money out of my wallet, and I can literally manage all of my global assets in one place without any hassle, without bank accounts, without structures, et cetera, et cetera. And so if I go here quickly and I just show you, because now it gets fun, which is the, oh, why is it not coming down? Sorry, my laptop's playing games with me today. So I'm just trying to get my Firefox to come down. Here it is. So let's just open it up quickly because I don't think there's anything more powerful than seeing it live. So if I go into Wealth Migrate, I literally log in. Now, obviously, I've already signed up, so I can just log in. That's why I wanted to show you the initial steps to get set up. I basically got my profile here. I've got my offshore account plus my local. I can do it my own name. I can go into my wallets. I can see everything in my wallet. As I said to you, in complete control of your money. I can also go in my portfolio and I can see exactly what's happening in my portfolio, my investments, my returns, etc. But for today, I don't want to take too much time. We've got this opportunity here, the Brisbane Co-Living as an example. I can literally go in, I can look at all the information, I can read about the risks. I can do an investment calculator, which I love. You know, if I'm going to do $10,000, what does it actually mean? It means that in, year 4, I'm going to have $17,000, $17,492. I can download all the docs. I can look at the risks. I can read everything, etc. But importantly, I now go and I want to invest in this deal. And literally, I can invest from $100. And I decide, right, I want to invest in this deal. I digitally sign all the agreements. And I go agree. And I make the investment. And you've literally just seen me invest into Australia in co-living in under 30 seconds. Okay, and there it is. And by the way, until the deal actually closes, I can also go, oh, sorry, I made a mistake there. I want to cancel my investment. I go remove my investment. The investment was canceled, and you can see it's gone, and my wallet has been refunded. So just to finish off, what I wanted to share with you was, we've spoken today about an opportunity, and we've spoken about different sectors. And under Property 5.0, we've been talking about co-living. Now, co-living is one of the fastest growing sectors in the world. Just like how we found and educated people around medical 10 years ago, and obviously medical's had a bit of a blip with regards to COVID. Is it going to be forever? No. Every sector goes through cycles of up and down. Another reason you should be diversified. But just like we taught everyone about medical 10 years ago, we're now starting to teach people about co-living, because this is one of the strongest sectors in the world, and it's going to be one of the strongest growth sectors over the next 10 years. In terms of the returns, it also is getting higher returns than any other residential investment. And just to put in perspective, multifamily, which is the American commercial residential real estate investing, has been the highest performing asset over the last 10 years. And co-living is actually doing better now than multifamily, which is why it's become such a focus in the US and in Europe, and now is becoming a big focus in Australia. There's also huge growth potential in this market, not just in a particular property, but in a particular sector. And just like with medical, it's very good to understand a sector. Student accommodation had its day. Industrial logistics is having its day right now. But the smart money gets involved before the crowd gets involved. Okay, and that's what we're trying to teach people about why co-living is such an opportunity. And so in conclusion, when I look at co-living for myself, why have I personally invested? Australia is the top performing economy post-COVID. Brisbane is the top market in Australia. It's also getting the Olympics in 2032. Affordability in Australia is a key issue. First-time home buyers are reducing because of affordability. Interest rates are rising, which will drive rentals. Densification is a major trend in not only Australia, but around the world. The bottom 25% of the market is the most stable market. So that's below 500,000 Australian dollars. And there's an expected increase in rentals once the borders open, once students can come back, etc., foreign students. Green, so ESG, green investing, is a massive trend for the future. And I think, with the Queensland floods that happened just last week, more and more people are waking up to the benefit of green investing. And, our co-living project in Kensington, in Brisbane, is a green certified building. And then co-living is another massive trend for the future. And as I've already shown you, that you have the opportunity to actually go online and actually invest at a 15% return. And I've shown you the benefit of diversification and what that means to your capital over the next 30 years. And to finish off for you, there's a good article here that I just wanted to share with you. And where's it gone now? Here we are. About millennials flocking to the nation's first co-living skyscraper. This is in Sydney. And if you want to, you just go and Google it. It's the Sydney Morning Herald around the benefits of co-living. So this is really a sector that you need to pay attention to. And sorry, I don't know why this keeps doing this. And then lastly, what I think is important is that I've shown you the value chain of real estate. I've shown you how people make money. And when you talk to our partner on the ground in Australia called 6C, they've got tremendous experience. I highly recommend you go and watch the recordings of the last 2 webinars to understand this. And what is their business plan? They are building 6 co-living opportunities, 1 in Brisbane and 5 in Sydney. And what is their exit? Please tell me, how did I tell you? How do people make the most money in property? See if you can type it in the chat box. Sonia got it right. Well done, Sonia. Selling to funds. That's exactly their exit strategy. They want to build 6 co-living opportunities. They want to be diversified. They want to season the rent, and then they want to sell it on to a fund. So you, as an investor, can choose. You can wait until the fund buys it, and then you can invest and get paltry returns and try and beat inflation for the rest of your life. Or you can go up the value chain and you can invest alongside the partner, who, by the way, is investing their own capital as well. And you can benefit and you can enjoy this journey. And personally, one of the reasons I'm investing, other than all the reasons I've already told you about the Australian economy and the sector, is because I too want to learn about co-living, just like I learned about medical over the last 12 years, because it is going to be a sector of the future that is going to outperform other sectors in terms of returns. Now, that's my opinion. I fully acknowledge that's my opinion. I'm telling you why I'm investing. This is not financial advice, just my opinion. You do what you want with the information you've got. So, in conclusion, do you want to invest here, or do you want to invest up the value chain in income-producing assets, or alongside a developer in growth assets? And what I've shared with you today is how you can do it, how you can diversify across countries, across assets, across countries, currencies, and across partners. I started off by showing you the 4 different segments, and I said whether you're a beginner, an intermediate, an advanced, it's all about your goal. It's all about getting to that freedom like my uncle's got. And how do you do it? You do it by building a balanced portfolio, a balance between capital growth and income, and ultimately investing for the long term. And so that's me. If you're interested, go to the platform, wealthmigrate.com. If you're in Asia and want to deal with Alex from Asia Property News, Property News Asia, then this is his QR code. Reach out to one of our wealth consultants. You can see the invest at wealthmigrate.com. And anyone that reaches out and deals with our team, we will share the wealth plan with. And anyone that fills in the survey, we will share the wealth plan with. Now, by the way, if you filled in the survey, we then know you're interested or not interested for that matter. Even if you're not interested, I don't mind. If you fill in the survey, we will share the wealth plan with you. So we are incentivizing people to give us feedback based on this webinar. So let's go to some of the questions. I'll leave the poll open while we're doing this. So Anonymous said, although different investments, properties, partners, etc., how am I protected against the risk of making use of one platform? For instance, Wealth Migrate. Isn't that like having different eggs in one basket? Great question. And the answer is no. All that Wealth Migrate is doing is facilitating your investments into multiple different deals with different partners in different countries with different currencies. Every single investment is in a different entity. Every single investment is in a different asset. Every single investment is effectively with a different partner. And so although we facilitate the investment, although we make it safe and simple for you to be able to do it, if we were to disappear, you would still have all your investments with those partners in their individual SPVs, which is a special purpose vehicle. and you would lose none of your capital. So effectively, the simplicity might go, but your investments would be protected. So it's the simplest and safest way to be able to invest around the world with a diversified strategy, rather than having to go and set up all your own bank accounts and structures in all the different countries, plus go and find all the different partners, plus go and do all the market research on all the different sectors, asset classes, et cetera, et cetera, et cetera. And by the way, what I've just described is why only the wealthiest people around the world, the Ray Dalios and his clients, have been able to fill and follow this strategy for the last couple of centuries. Now with technology, you and I have access to it. And I know Anonymous wrote down their name. I'd love to know who Anonymous's name is, because it's a very valid conversation. And I'm very glad you brought it up, because risk is the most important thing when one's considering an investment. You always need to look at return of capital before you worry about return on capital. Maria asked me, what are the 9 different asset classes? Maria, it's interesting. If I was to go here, and let me just close the poll. Hang on, I'm going to go back to the poll. I can see 44% of you have answered. So if the rest of you could answer quickly, then I will close the poll. I'll give you another 30 seconds. While I do, I want to open up the different asset classes that I can show Maria. So, okay, going 10 more seconds for anyone that wants the wealth plan or fill in the survey. 10, 9, 8, 7, 6, 5, 4, 3, 2, 1. So if you look here, Maria, and we go back to the marketplace, I mean, just now at the moment, you've got 3 different asset classes here. You've got a structured note, you've got co-living, and you've got a quarterly basket, which is a distributed asset class. Over here, you had a different structured note with a different partner. This is a structured note. This is a medical deal. This is industrial, so logistics. This is a different type of industrial, so it's a different type of asset class. You've got a convertible debt, so effectively a convertible debt instrument. You've got multifamily. This here was in medical, how do I describe it basically? Anyway, it's a different asset class, and it was also a 12-month instrument. Oh, sorry, I got them the wrong way around. The other one was 12-month. This is a 6-year one. This is an office park, so it's in office buildings. This was a new development in Portugal. This was a multifamily. So I'm just giving you an example. This was an asset in South Africa, which was a debt instrument. This was an office park. This was aged care in the UK. So I'm just giving you an example, Maria, of the different asset classes that come through. And just by the way, from our perspective, we are looking to do more and more diversification. So we are looking constantly to bring on, we're looking to bring on green energy at the moment, sustainable energy, etc. So we're constantly looking to bring on quality alternative assets so that you and I can be diversifying across different countries, currencies, assets, and partners. So I think I've answered both of those questions. Let's go back to the chat box. People have said, yeah, selling to funds. So well done to those of you that said selling to the funds. Tell us more about the funds. I'm not sure what you're talking about there, Chiswaro. Sorry, I'm not sure if I'm pronouncing it right. But ultimately, the way it works in property, if you go back to the value chain of real estate, and let me just, if I just go back here, it's this slide here, this one here, is that the real value chain of real estate is made where a developer builds a building, they then season the rent, so they fill it up, whether it's residential or commercial, they fill up the tenants, they basically prove that the income's working, and then they sell it to a fund or a REIT. I've watched many, many people, wealthy people around the world, and this is the number one way that money is made in property. And then the fund or the REIT list on the stock market, and you and I invest in it. So I don't know if that's answering your question, but that's what I was talking about with the funds. And my point being is that just like with Uber, why don't we as investors go up the value chain? Why don't we skip the middleman? And why don't we invest directly alongside the investors and directly alongside the partners. And hopefully today, based on the spreadsheets I've shown you, is that not only does that make logical sense from a risk perspective, but it actually makes logical sense from a returns perspective. Okay. And Maria, you said I meant the 9 different asset classes you invested in. I've basically just shown you, because I personally have invested in every single deal that we've done on the platform in the last 12 months. So I want to go back to the concluding slide. This slide here. Are there any other questions? I know that we're just over the hour, and my purpose was to, try and share with you how you can diversify, how you can follow Ray Dalio's principles and the other wealthiest investors around the world, how you can use technology to do it safely and simply. I wanted to emphasize the massive opportunity that co-living represents right at the moment. I also wanted to emphasize the opportunity that green investing represents, and the opportunity we've got on our platform is both co-living and green. And lastly, I wanted to let you know about the webinar that we've got next week, where we'll be talking with some massively qualified partners and authorities on the Australian market, on Brisbane, on the property sectors, and where the opportunities lie. And if I've learned one thing about investing, there's only 2 important components to successful investing. It's getting the right information and having the right partners. And so what we're trying to do with regards to these webinars is for you to get the right information and get access to the right partners. And so I just want to check here quickly if there's any more questions. Otherwise, I will close it out. Example of relevant funds. Again, just so I'm not sure what you're referring to. I mean, there's property funds all over the world. There's REITs, real estate investment trusts all over the world. If you think of any pension company, it's the principle we're talking about, not the specific fund. But I'll give you an example. We've been investing in medical in America since 2014. As I said to you, on average, we've been paying our clients a cash-on-cash return of 8%. There's a very popular medical REIT, real estate investment trust in America, that consistently over the last 10 years has paid 4.75%. And I always say to people, what's the difference? Are we cleverer? Are we better at investing? Are we better negotiators? And the honest truth is it's none of that. We just cut out the middlemen. We've cut the costs, and the investors are investing directly alongside the partner. Lolita said, thanks, this is fantastic. Do you have this recorded to send? Yes, I do, Garth. So it is recorded. We will share with you. And as I said to you, for those that are part of our Wealth Hackers, which is our inner community, I'll share with you the spreadsheets so that you can do the maths as well. I love people making educated and informed decisions. Perfect. So I think with all further ado, Paul, I see you online. I'm not sure if you're there, if there's anything you want to add. Otherwise, I will close it out for today.
No, it's all good, Scott. The only thing I mentioned, it was just amazing the previous 2 webinars. And I just think that I just had shivers after seeing them, thinking, wow, the world is going in this direction. And Wealth Migrate spotted a trend that's like the medical one, well ahead. So that's all I would say, that last webinar, maybe you could share that somehow to the people. How will they find out about that? How they can see that? Is there a way?
Yeah, so we'll send out a link. We'll send out an email to everyone that registered for this webinar, and
yes,
make sure that you've got the recordings to the previous 2. I do agree with you, Paul. I personally was on both of the webinars, and quite frankly, they were so good that I was talking with my team yesterday and saying we need to re-watch the webinar, because when sometimes there's so much quality information, you actually have to watch it a few times to really get the nuggets of great information out of it. I mean, that
exactly. The second one, both of them were good, but the last one was, it's sort of like you're getting a crystal ball to show what people are going to be investing in 5 years' time, and all the reasons why, and all of the data that's backing up, and virtually nobody knows about it, which is crazy.
Completely. And again, how does Warren Buffett and the others make their money? They don't wait until everyone else is doing it. They're ahead of the trend. So
exactly.
That's why we're doing these webinars. Awesome. Well, thank you very much, Paul, coming live from Brisbane. And I thank everyone who's been on this webinar. I hope it added value to you. And most importantly, if you enjoyed it, share it with your friends. Go and take action. Speak to one of our wealth consultants, invest on the platform, speak to Alex, or let's see you next week when we discuss the Australian economy, the different property sectors, and where the opportunity lies. Till next week, cheers.